So with being gone the last few days, I'm really hoping to be back tomorrow. I just wanted to quickly go through chapter 5 so we can keep moving. We are going to introduce one new concept, and we're going to talk about closing entries. So chapter 4 focused on the adjusting entry, which just essentially updates all of your accounts. Once your worksheet's completed and you've done your financial statements, the last thing we do is we close out our temporary account. So I'm going to show you in the slides here what that looks like. And then I'm going to do another short little video to do a review assignment and give you some practice. So closing entries. Okay, so the purpose of closing entries is to close or zero out the temporary equity or nominal accounts. Okay, so they're made after the last adjusting entry and after the financial statements have been prepared. Okay, so what it does is it updates the owner's capital account. So here is kind of an example of what it looks like. Our drawing closes, our revenue closes, and our expenses close. And there is a process for this. So we basically are just zeroing out temporary owner's equity accounts. That's going to allow us then to start a new accounting period. So the procedure for closing is to simply take the balance of the account, in other words, to make the balance equal to 0. So if an account to be closed has a debit balance of $870, we have to flip-flop that. So in order to close it, we will credit that account $870, and then that will zero that account out. So here's what it looks like. So the first thing you do is you close the revenue account. It's important that we do the steps in these order. And again, I'll show you here with the slides and we'll do a practice one together. Okay, you're going to close the expense accounts into the income summary. So you're noticing this new account here is called income summary. That's the account that we use essentially. It's called a contra account. That's what we use to close these temporary accounts. Third step is we close the income summary into the capital account. So if we had a net loss, that's going to make our capital go down. And if we had a net income, that's going to make our capital go up. So we're closing our net loss or our net income and transferring it into the capital account. And then step 4 is to close the drawing account, which in turn is going to reduce the capital. So here is the first entry. So the first thing we're closing here is our revenue. Okay, our revenue is income from tours. This on your worksheet would have been a credit. So in order to close it, we need to make this entry as a debit. And then we credit our income summary. Okay, step number 2, we're going to go ahead and close out our expenses. So going back to your worksheet, you would notice that your expenses would all be debits. So in order to close them, we list them all separately as credits. We total it up and we debit our income summary. So our debits now match our credits. Okay, step number 3. When you look at your worksheet, what you're going to find is this was our net income. So from that little spot on your worksheet, you're going to go down and see if you had a net income or a net loss. In this instance, we had a net income. So we put it into our income summary. And then we credit our capital. So when we post this, it's going to make our capital bigger. I'm going to skip through some of this here. I don't want to confuse you. Okay, and then step 4, we're going to close the drawing account into the capital account. So going back to a basic T-chart here, drawing typically has a debit balance. In order to close it, we need to credit. Okay, and then we use our capital. So we need to debit our capital here, which essentially is going to make our capital go up. So here is all 4 steps shown out in the general journal. So the last piece of this now is that you just need to go back and you need to journalize I actually think we're going to look at it here. I'm going to backtrack. So when you're posting, sorry, I didn't mean journalize. When you're posting, it is going to look exactly like the posting before. The one difference you're going to see is that in the ledgers, you're going to either write adjusting or closing. So we post exactly from our journal. So you would find income from tours. You would put it in as a debit of $23,320. You'd find your income summary. You would credit $23,320. I'm going to skip forward here to what that's going to look like. So if you notice in your general ledger where it says item, okay, the new piece of this is that you're going to actually write either adjusting or closing in here as we journalize these entries. So here's some more examples. And if you notice here, like all of your expense accounts are going to close out. So they should be at a 0 after you have completed this process. Not all accounts will close. Your revenue will close. Your expenses will close. Your income summary should close. And your drawing should close. So again, here's just examples of your expense accounts. After you've posted the adjusting and closing entries, you can see that they have closed out to 0. And then the last piece of this would be to create the trial balance based on what you have left in your journals. So I'm going to go ahead and stop the presentation here. I will share this presentation with you. I am going to do another short video on, I believe it's 5.3a. I'll show you how to work through that, and then your assignment will be to work through 5.3b, and it's going to all be done electronically on the Excel sheets.